welcome along to the Property Academy podcast by Opus Partners. I'm your host, Stephen Knight.
And I'm Andrew Nicol.
And today's on the show, we're talking about interest rate rises and why the worst may be over for property investors. Now, the latest inflation numbers recently came out last week. At 7.2% was the annual inflation number, same as last quarter, slightly down though from the highest point, which was 7.3%. But you know, some people, Andrew, are going to find that really scary because the last time we had 7.2% inflation come out, interest rates increased by about 1% pretty rapidly. And they might be thinking, are we going to see another 1% jump because we had the same level of inflation? And you know, I was in two minds about this. One, I was really annoyed because
I saw your post.
well, inflation is nobody's friend, and it's still really high. Remember, the Reserve Bank is trying to keep inflation between 1% and 3%, and at the moment, there's a lot of negative sentiment out there in the New Zealand economy. The quarterly survey of business opinion recently came out and showed that business confidence is its lowest in over 50 years since that survey began. And so in one mind, I was really annoyed because negative business sentiment, people feeling bad about how the economy's going, that should bring inflation down. And if we haven't seen inflation drop, even though we've got all of that negativity out there, that started to make me think, oh, this isn't very good, is it? But are you seeing that with some of your business owners out there? Are you seeing a lot of negativity in the market?
Well, yes. The other side to it, though, is a lot of what happens in financial markets depends on what is expected to happen and then what happens. Now, we were expecting high inflation still, and we got high inflation. Last time when we had an expectation of inflation being a lot lower than what it actually was, that shock to everyone's expectations was what caused a jump in the interest rates.
Okay, so let's go through this because you're absolutely right. So the reason we had interest rates rocketing up the last time the inflation data was released is that the broad expectation from the Reserve Bank forecast inflation to be 6.4%. In reality, it was 7.2%. So it came in almost 1% higher than they expected. And the outcome of that was the Reserve Bank came out swinging, delivered a really aggressive monetary policy statement and said, we are going to ramp up interest rates. It's a bit different this time, and let me show you why. So this quarter, the Reserve Bank expected inflation to be 7.5%. In reality, it was 7.2 again, so it came under by 0.3. So what sort of response are we going to get from the Reserve, or are we likely to get from the Reserve Bank this time, Andrew?
Well, I would imagine they're still probably going to play it pretty safe, and you're probably still going to see an OCR increase a little bit, but it might be that we don't see an increase to the extent that we were expecting. What do you think? Do you think the OCR is going to go up?
Well, it's definitely still going to go up. But what you've got to remember is the Reserve Bank was saying the last time they gave their monetary policy statement, they said we're going to ramp up the OCR to 5.5%. Now, that was significantly higher than what they were suggesting they were going to ramp it up to before. Now, we are still going to see an increase, but potentially not to the same amount that you were expecting. So I'll give you an example. ANZ recently, after the inflation numbers came out, they said, we don't think the OCR is going to increase as much as what we previously thought. So they thought it was going to go up to about 5.75%. Now they're saying, we only think it's going to go up to 5.25%. Kiwi Bank was exactly the same. They were saying, we only think it's going to go up to 5% now, even though the Reserve Bank says we're going to take it up to 5.5, or at least that's what they said the last time they came out. Now, that becomes really crucial when we're starting to think about mortgage interest rates, right?
Well, so I think last time we had the stats come out on inflation, previous to this one, there was such a shock between what was expected and what was reality that the Reserve Bank had to make a swift change, and that affects the wholesale market. And of course, if the wholesale market changes, that's what's going to affect our retail interest rates. And so therefore they went up at a drastic rate. This time round, it was pretty much within cooey of where we expected it to be, but it was actually better on the better side of the equation.
Yes, and so because of that, it's not like we're going to see another drastic change in the Reserve Bank. So they're not going to come out again and say, we need to be even more aggressive, which is then what would cause interest rates to have that large jump like we saw last time. That's why it's different.
Okay, so we've got some good news that the OCR potentially isn't going to go up as much, but if the OCR goes up by another 0.75%, 1%, won't interest rates go up by the same rate?
No, because the OCR and mortgage interest rates don't necessarily move in lockstep. You know, over time, if you average it out over a quarter or 6 months, they do tend to move in the same direction, but day to day, not as much. And the reason behind this is that interest rate markets are forward-looking. And so the way this works is if a bank's going to lend you money for 1 year, they go and they borrow that money from somebody else for 1 year, they bang a margin on, and they lend it to you. And so what you've really got to consider when you're thinking about what interest rates are going to do in the future is what is happening to the people, the people who lend money to the banks. And those markets tend to be forward-looking. And so they're already pricing in the fact that the OCR is going to increase. So let me give you an example. If we see the OCR increase by another 1%, that doesn't mean that the people that the banks borrow off are going to increase their interest rates by 1% because some of that is already priced in.
So what do you mean by priced in? You mean that they've already accounted for the fact that there's an expectation of that going up?
I'll show you exactly what I mean. And you guys who are watching on YouTube can see this. You guys on the podcast, let me explain it to you. So what I've got mapped out, and take a look at this, Andrew, is the difference between the 1 year wholesale rate minus the OCR. And what we can see is that on average, there's about an 0.5% difference between the 1 year wholesale rate and the OCR. So if the OCR is 2%, the 1 year wholesale rate, which the banks are paying, on average, 2.5%, and this is from February. What do we see happening right now, Andrew?
Well, we see that currently the wholesale rate is priced way more expensively than what the OCR is.
Yeah, so if you think, okay, there's usually an 0.5% margin between the 1 year rate and the OCR. At the moment, there's about 1.2 percentage points. So if the OCR is currently sitting at 4.25%, the 1 year wholesale rate's about 5.5. So if you say over the last couple of years, there's an 0.5% margin between the wholesale rate and the OCR, right now there's a 1.2% difference. What's the difference between those two?
0.7%.
Yeah, so that suggests that the wholesale markets are pricing in an increase of about an extra 0.7% to the OCR. And we're being really crude here in terms of it, but this is how we can get a ballpark. Now, let's say that ANZ is right and that the OCR lifts by 1%. Well, if 0.7% of that is already priced in, how much more might the wholesale rate increase by? 0.3%. And if currently we have ANZ's mortgage interest rate is about 6.6%, if their borrowing costs go up by 0.3%, where's the 1 year rate going to end up?
6.9.
About 6.9%. At the moment here at OPAS in our forecasting, we're saying that the 1 year interest rate might peak at around 7%. And I know that we've just gone through some really nerdy stuff, but it kind of suggests that when we look at what the wholesale markets are doing, when we look at where the OCR might end up, it kind of sounds about right that the 1 year rate is probably going to peak at about 7% mid this year. Now, Andrew, what interest rates are we using in our forecasting?
So at the moment for our return on investment calculator, we're using a 7% interest rate now, which I know is higher than what people are getting today, but we like to be conservative there. Next year, we've now made our 6%. The year after, we've worked on 5.5, and in year 4, we've worked on 4.5. Now, again, they're not going to be these rates. We might get it right one of the times, but they're going to be around this based on our forecasting.
But here's the thing. If you're going to do any sort of cash flow forecasting for your investment property, the key thing is you have to choose some interest rates, you've got to take a stab and say, these might be what the interest rates are in the future. I'm going to model my cash flow on that basis. You're never going to be 100% right, but if you've got to create any sort of forecast, you've got to make some guesses about what those interest rates are going to be. Otherwise, you're just going to be flying in the dark anyway, not having a cash flow forecast.
So, Ed, what could change in all this?
Oh, look, forecasting can change all the time when we're talking about these interest rate predictions. But look, one thing that could change it is if the Reserve Bank still comes out overly aggressive. So inflation came out underneath their forecast. If they came out and weren't, a rational actor, if they came out very hawkish again, that could change this. We don't expect it, but you've come to learn to expect the unexpected over the last couple of years. Or if something surprising happens. So if China's economy really opens up after they've ended their zero COVID policy and we see a lot of economic activity that leads to a lot of demand, or if for some reason we saw restricted supply out of China, those are the kinds of things that could happen. But whenever we're making predictions, and this is for all economists, you look at the data available today and you say, where does it look like we're heading? And then events will crop up and we will adjust as we get new information. And that's really the basis you've got to make your decisions on. So long story short, some good news that interest rates probably won't rise as much as we were expecting only a couple of months ago, but there's a lot of uncertainty as well in the current market. We're going to wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to learn more about property investment with Andrew and I, you've got to subscribe to our YouTube. We release new videos every Monday and Wednesday. Just Google Opus Partners YouTube. If you're listening to the podcast, you'll be able to find it at the top of Google. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight. And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the property market. Until next time.